today we're going to be looking at the different ways to make a good swing trade and to find a manipulation and daily bias of the day. So now in this first example, we're going to be using the fib extension, which is this tool right here, right, the trend-based fib extension. So we're going to be using this tool, and on my next example, we're going to be using a Fibonacci extension retracement. So in this case, I have steps here that we need to follow to find the exact steps that you need to do to be able to find a very suitable and convenient and very convenient daily game plan for the day. So firstly, as I've written here, fib extension, swing trading, Judah swing. The first thing you need to find the Judah swing. So what you need to do is to measure the range from 18 hours to midnight, which is right here, 18 hours to 00 hours. So this is the Asian range. So I won't get into detail why I'm making this an Asian range, but we have a mentorship where we explain more of these. And if you can subscribe to my channel, let me hit like 100 subbies. I'm gonna be making live trades, live lessons, and I'm gonna be showing a lot of gems when it comes to trading. So hit that subscribe button so we can be able to connect more. So once we've measured the range from 18 hours to midnight, step two, take the fib extension and measure the second standard deviation to find how far is the price likely to run as Judah swing or manipulation. So here is the Fibonacci extension. First thing I need to do is to measure from the top to the bottom right here. Then I click at the bottom again. Then I bring it up, I push it back to the buy side here, to the top side, and click again. As you can see here, we have the second standard deviation, which the price retrace to this level here, and it filled our second step, which to make the measurement second standard deviation. So the price did go to the second standard deviation here, which we use the second standard deviation for a Judah swing and the fourth standard deviation for distribution of the day. So the next step is look for PD array to align with the second standard deviation for reversal. So right here, we have this rejection block, which is these candles here, these two candles here that create the rejection block where the price retrace to. And this is where you're likely to take your entry if you want to go long for the day. So if the minute you figure out how far the price is willing to go for Judas, you're gonna need to find on how far the bias of the day is likely to go. So I'm gonna remove this fib retracement, and now I want to find how far the price is likely to go. So I'm gonna measure from this low to this high here, and then back again right here. There it is. So now we found the second standard deviation. The same rules apply. Measure the range from 18 hours to 00 hours, then take the fib extension and measure the fourth standard deviation to find how far the price is likely to go for the day. So here is the fourth standard deviation. I'm just gonna mark it. Here is it here. There it is. Then I'm gonna remove my fib extension because now I've already marked the fourth standard deviation, which is right here. So the next step is look for PD array to align with the fourth standard deviation for daily target along with the run on liquidity. So here we have this fourth standard deviation here, which is our initial target. So now we're gonna look for liquidity, which is this buy side liquidity here. We're gonna look for a PD array, which in this case we have this fair value gap right here. We have this fair value gap here. So this was our initial target because there's also buy side liquidity above these highs and also above this high here. So now we have found our initial daily bias on how far the price is willing to go for manipulation, which is the Judah swing, and how far the price is likely to go for the target of the day. So this can be your exit, or this can be your exit on the first standard deviation after the price took out the buy side liquidity. So this you can hold a trade from this Judah swing, which is the rejection blocks here, to this high. So this example we are using a fib extension. So I want to make another example when we're using a Fibonacci retracement. So I want you to show the difference between fib extension and Fibonacci retracement. They both work the same way, but they are not the same. So if you can be able to get these measurements, it's going to make your trading to be very, very simple. So now I'm not going to move very far. I'm just going to make the examples here on the next day on how the price is likely to move well, regarding to the Fibonacci retracement. So let me just make my imitations and just show you in a second. Okay, guys. So now that we figured how to use the retracement, which is this one, the fib extension, we measure from this to this and then back to this. It's gonna lead us to our second standard deviation, which is the Judah swing, and do it again from the low to the high and back. That give us a fourth standard deviation, which is the initial target for the day, the daily bias for swing trading. So now that we figured out how to use the fib extension, so now we're going to be making an example using a Fibonacci retracement, which is our regular Fibonacci. So we have this consolidation here, which we measure the range from 18 hours to 00 midnight. So in this case, when we're using a Fibonacci, we measure from 18 hours to 00 hours, the highs and the low, using only the bodies. So we're gonna measure from this body here to this high here, to this high here. So now you see that we measured the body. We didn't use the wicks, but we used the bodies to measure when we're using the Fibonacci retracement. But when we're using Fibonacci extension, we're gonna be using the whole wicks with the bodies. So that's the difference between the two. So here we have the price that's just run to the second standard deviation, which is a turtle soup. In our mentorship, we explain more about how to trade a turtle soup because if you can see here, we have this previous day high here, which was the steady range high. So now the price have taken out this high here as a Judah swing. Traders are probably thinking the price is going to go higher, but no, the price is going to the second standard deviation before it can give the initial bias of the day. So now that we've seen this buy side liquidity and the price has run to the second standard deviation, now we're going to look for where our target is. So still you're going to be using body high to body low between these ranges here. So this is going to be our initial target. Yeah, this is going to be our initial target, which is the fourth standard deviation where price is likely to go for the day. So excuse me. So this is where the price is likely to go for the day, which is the fourth standard deviation. So you can take your sell here if you want to swing trade, you can take your sell from this Judah swing here, and your exit is going to be from either this the fourth standard deviation right at the tick, or you can take it. We can take your partials like below the in a period array that's below the standard deviation. So here we still have those same analysis. Take a Fibonacci and measure second standard deviation to find how far the price is likely to go as a run on Judah swing or manipulation, which is the one we figured when we measure from body to body, from high to low. This is second standard deviation. Then to find the daily bias, measure the range from 18 hours to 00 hours, which we did here. Take the Fibonacci and measure fourth standard deviation to find how far is price likely to go for the day. So we did from the body high to the body low, we found the fourth standard deviation, which is here. Look for PD arrays to align with the fourth standard deviation for daily targets along with the run on liquidity. So in this case, let me just remove this fib. In this case, we don't have liquidity here, but we do have a balance price range, which is the 15 minutes balance price range here of the 10 1 minute here. So let me just fix this, which is the 15 minutes balance price range where price has run to. So this can be your initial exit of the day. So basically what I'm trying to say is that the deviations, they are not reversing the price, but they give you an extension like how far the price is willing to go before it can run to an opposing liquidity, which in this case we have this four standard deviation. So this as is the balance price range, the PD array that's below the four standard deviation, that's where the reversal might be. Also here we have a second standard deviation, but we have the rejection block, which is aligned with the deviation on how far the price is likely to go. On here, we have the fourth standard deviation, but above it, we have this buy side liquidity along with this 15 minutes fair value gap. So that's how a standard deviation works. So in this case, we call it a turtle soup because this is also a model. It's a turtle soup that we use to find entries also. So we have more of these gems in our mentorship. So hit the subscribe button so we can be able to make these live teachings, live executions. We can even check out on our channel. We have a few of videos that we do the same examples, how to find execution, how to find exits using our very own 7-Eleven model. So we have also our live executions that we did. So if you can just subscribe to our or subscribe to our mentor to our YouTube channel, so you're gonna be able to get more of these gems. So I hope you find this one insightful. Until we talk again on our next video. Cheers. Have a very good one.